From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Ferro. Is a little bit of softness to the market. Is it the Google effect? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, markets on edge, futures under pressure as earnings keep rolling in. A tale of two clouds, Alphabet and Microsoft delivering mixed results. And House of Cards, Republicans floating yet another name to be the next speaker. We begin with the big issue, earnings season ramping up.
This is an incredibly important week from an earnings perspective.
The magnificence of the big cap tech names.
Front and center is all about the cloud. Business of Microsoft did very well, whereas it disappointed in Alphabet.
I am a little bit cautious on these tech earnings going through.
Year-to-date returns have been really good.
Meta obviously is one that you want to watch very, very closely.
If you think about the tech group as a whole, AI has been a big driver.
They're sensitive to the AI data points.
It's not so much what's happened, but for me, it's those outlook statements on what consumers are going to be doing.
It's absolutely about the guidance.
Really, the question is looking ahead.
When you think about future stock upside from here, we are very much focused on that earnings picture.
We're going to be counting on big cap tech and communications to do the heavy lifting.
It's absolutely critical whether the big seven do continue to produce the earnings growth the market's expecting.
Joining us now to discuss is Hightower's Patrick Frazzetti and Zachary Griffiths of Credit Certs. Patrick, I want to start with you. How much are we actually getting some sort of narrative from these earnings versus a stock-by-stock, story-by-story type of micro picture that people used to know before, say, 2007?
Yeah, well, I think when you look at tech earnings particularly, I mean, as tech goes, so goes the market. We've seen that this year. We've seen that out of the large 7 tech stocks. I mean, price to earnings ratios now close to 45. I mean, that's up from the high 20s earlier in the year. If you compare that to the rest of the S&P 500, no, it's actually the rest of the S&P 500 is reasonably priced in the high teens. So what we're looking for with some of these tech earnings, of course, they're mixed. You know, Microsoft was pretty solid. We saw some growth in Asia and cloud, and Google was really the opposite. So we'll see how the rest of these come out as the week goes on. We certainly got a slew of bank earnings last week, and we can talk about that in a bit as well.
Well, but Patrick and Zach, weigh in here, because as we're looking at the fundamentals, it has to do with the wherewithal to pay back debt, the wherewithal to maintain cash flow at a time where the consumer is still strong. From the earnings that we have gotten so far, and it is still in the beginning throes of earnings season, Zachary, how solid have some of these balance sheets looked?
Yeah, Lisa, when we look at balance sheets in aggregate, really across investment grade and high yield companies, you really haven't seen the bite of higher rates just yet. Management teams have done a pretty good job of pushing out maturities, and so that's something that we're definitely focused on in 2024 as a reason to see some deterioration in fundamentals. But from a consumer spending perspective and the strength of the consumer that we've seen, we're really not seeing that deterioration in balance sheets. Even interest coverage that's come down a bit from recent highs hasn't really tumbled off a cliff. And so when we think about the fundamental picture in 2024, we still think it's solid, as we're not looking for the economy to roll over into a recession.
Patrick, you said something earlier that where tech stocks go, so too goes the entire S&P. At what point are you starting to see a breaking apart of that kind of idea when you do get the likes of Microsoft and Alphabet or Google report such different earnings pictures?
Yeah, well, look, if the market, was able to sort of, digest that and differentiate between these earnings, that would be a good thing. I just don't think where some of these companies are priced, it's reflecting that just yet. But like I said, there are 493 other companies. We look at those individually. There are certainly some interesting companies and sectors out there today that are reasonably priced. And so, if we start to see that differentiation, good. I think we should. In a higher interest rate environment, you should begin to see that. As Zach mentioned, when you think about, corporate credit and some of these companies have termed out their debt longer, that's great. I mean, that's a good sign. But we'll continue to see, which companies are pressured. I mean, this won't be, the last quarter where we see this. We'll begin to follow this narrative, in the coming quarters.
Patrick, right now, from what you've seen, are you getting more bullish or less bullish?
I'll tell you one thing. I'll just talk about bank stocks for a second. We're 6 months removed or 7 months removed from, what was really a banking crisis. And you started to see regional banks, banks overall, just back to their March lows. And I just don't think you can have a healthy economy, a healthy market without a healthy banking system. It doesn't mean that we're seeing defaults or anything like that. I just want to, you saw in the Journal this morning, some of these regional banks that reported, commercial and industrial lending is down. And so if we start to see that improve, then I'd become more bullish. That's what I would say.
Zach, just picking up on Patrick's point there, where he was talking about how a lot of companies are paying down debt, not incurring new debt. How much is this technically what's underpinning the credit market, given the fact that there just isn't going to be that much issuance at rates that are the highest going back to before the last financial crisis?
We do think that's important from both a technical and fundamental perspective. And one of the things that we've been discussing with clients in meetings recently is that management teams are going to be more responsible going into next year. You're not going to see this intentional re-leveraging that we've seen in the past that can lead to problems down the road, especially as rates are higher and you've had decompression in terms of borrowing rates across different rating sectors. And so you certainly want to protect your investment grade rating, whereas in the past cycle, in that expansion where interest rates were so low, you really didn't get penalized to move down the rating structure. And so that allowed for more leverage to come into the system. So we're not expecting that. And we think that is a tailwind for corporate credit in 2024 when we think about the fundamental perspective, and will only be slightly counterbalanced by the higher borrowing costs that will have to be realized.
Well, how much do you then see, Zach, a divergence right now between investment grade and high yield widening dramatically in response to what you were just saying?
Yeah, we think the move in high yield has been interesting, and we thought that spreads had been more resilient over the past couple of months with the move higher in rates really across the Treasury curve. And so we are looking for continued near-term caution with respect to our recommendation on high yield credit. But if we get back toward that 500 basis point spread level, we think when you think about all-in yields, that's an attractive point to get back in, as we are looking for economic growth to remain positive and financial markets to remain functioning nicely in 2024.
Speaking of economic growth, from earnings over to the data, investors looking ahead to fresh GDP figures as the Fed goes quiet this week, mostly. Bloomberg's Michael McKee joining us now with a preview. Hey, Mike, welcome back.
Thanks. It's going to be fun tomorrow, Lisa, when we get the numbers at 8:30, because the predictions are for a very strong growth figure, but some have it even stronger than the Bloomberg consensus of 4.5%, which would still be the biggest since 2019 if you leave out the pandemic years. Personal income and spending and the PCE inflation numbers then follow on Friday. So we've got 2 big days of numbers that could, probably won't, but could influence the Fed next week. But it's definitely something the markets are going to be taking into account. Now, here's why everybody is going to be watching GDP and the strength in GDP so closely. I took out the pandemic years basically because they throw every chart off. But if you look at this closely, you'll see that every time the Fed is raising rates, GDP is falling, except for now. And why is that? We don't know. And so does that mean the Fed is going to have to do more? Or does that mean that inflation is going to continue to come down just because this is a weird time? That's going to be the question of the day, debated at 8:31 tomorrow. And then the question going forward is, what does it mean, as I said, for the Fed here and Jamie Dimon and those who are concerned about what happens next year? That's the dot plot from September, and you can see how wide the dispersion is. But basically, the lines that count are the white and blue lines. White is what the Fed thinks, at least in September, thought was going to happen. And blue is what the market thinks is going to happen to the Fed funds rate in 2024. And it'll be interesting to see how that market perception changes after we get these next 2 days of numbers.
Michael McKee, thank you so much and welcome back. Mike was saying this is a weird time, and I want to pick up on that. Patrick Frazzetti and Zach Griffith still with us. Patrick, from your perspective, is this time different? We keep hearing that normally when yields get to 5%, things break. Normally when you end up with this type of hiking cycle, GDP goes down. It is accelerating. What makes this time different?
Well, I don't know if it's different, but I'll tell you what is different is an extremely tight labor market, right? So we've seen, I think inflation has become very sticky, and I think it'll continue to do so. Just look, you see every day headlines about a strike and whether it's been averted or whether it's continuing. Obviously, we've seen it in all industries, and so I think that is different. So you have a tighter labor market, so you don't necessarily see the same direct impact yet on the economy. But with higher interest rates, it's harder to borrow, it's harder to buy a home, it's harder to buy a car, and the returns on a project, if you're a company and you're looking to invest, have to be pretty good. I mean, you're borrowing at probably 9 or 10%. So I think we're not out of the woods by any stretch. We have to carry this thing forward. I think there's a little bit of a lag effect, and we'll see where we are throughout the first half of 2024.
Zach, where are you on this? We were just speaking with Jim Bianco from Bianco Research, and he was saying what we've seen is just the amount of savings. The economic shock of 2020 has been enough that actually 5% Fed funds rates is the normal, is the base of what it needs to be, and everything can keep accelerating from here.
Well, Lisa, with what we've seen in terms of economic activity, it's easy to make that argument. But I think the lagged effect of the tightening that we've seen over the past 18 months has yet to be felt. And when we look ahead, we do think you can see inflation continuing to come down. You have student loan repayments starting this month. You have commercial banks tightening credit. We think there are some pretty clear disinflationary signals that are going to play into 2024. And so when we think about it being a weird time, we do think that economic growth has been more resilient, but inflation can continue to come down as we're still seeing some of the supply side problems that we had over the past couple of years come out of those numbers. And so while economic activity is going to have to downshift for inflation to get back toward that 2% target, we think there are enough factors lining up in 2024 to provide that. And when you think about what's really driven the U.S. economy, it's been the services spending. And we think as excess savings come down and are potentially completely eliminated by the end of this year, and the unemployment rate starts to rise, that really comes off, and you see GDP come off the boil.
So at this point, are you talking about basically we can avoid some sort of recession and still get disinflation enough to bring us back to the Fed's target, Zach?
That's our base case, and that's certainly been a hard argument to make when you look at past tightening cycles and how that's all unfolded. But we do think all of the tailwinds that we had from fiscal and monetary stimulus over the past couple of years has finally worked its way through the system, or is at least close to that point. And so I think that why people have been so surprised with how strong economic growth has been, some of those drivers are coming off, and you're going to have to see some of these more traditional factors that play into economic growth have a larger impact in 2024, but not so much so that the economy completely falls off a cliff.
Patrick Frazzetti, Zachary Griffiths, both of you are sticking with us. Let's take a look right now at some of the stocks moving ahead of the opening bell. Abigail Doolittle with us. Abby.
Well, Lisa, as you said before, we have a tale of two stories between the cloud, or in the cloud, between Microsoft and Alphabet. Markets overall seem to be siding with Alphabet with that little bit of a soft tone. But take a look at Microsoft, popping 4.7%. Revenue overall up 13%, better than a year ago. And the cloud, a bit of a relief, up 29% and above the growth for the three preceding quarters, even though it's missing on a year-over-year basis. Alphabet down 6.1%. Now, they put up revenue that grew 11% to $77 billion, but that cloud growth slowing to 22%, or about $8.4 billion. Investors disappointed in that. And then finally, Boeing up 3.6%. They missed earnings by 10%. You wouldn't think the stock would be up, Lisa, but they maintained the free cash flow outlook for the rest of the year. They also talked about double digits by mid-decades, and they kept their delivery target for the 787 wide-body. Investors liking that, sending the shares of Boeing higher ahead of the open.
Interesting. Abigail, thank you. Meanwhile, coming up, the drama in D.C. continues.
What we need to do really is come together as a party. We're going to have our differences, but we have to understand that the real differences we have are between Republican and Democrat.
House Republicans picking their fourth speaker nominee with a floor vote expected at noon. That conversation coming up next.
sadly enough, we've gone through many individuals. I did not personally think McCarthy needed to be taken out. There's an absolute urgency to get this done and actually get back to passing appropriations bills, getting back to appropriating money where it needs to be for the country. But again, you know, we have some folks that are at no, begin at no, and want to move, and we're trying to get them to move to yes. What we need to do really is come together as a party.
It's another chapter in the speakership saga, with the GOP hoping for a conclusion, finally. Congressman Mike Johnson of Louisiana becoming the party's fourth nominee in 3 weeks. The House expected to hold its next floor vote at noon Eastern. Johnson receiving support from former President Donald Trump, posting online, quote, "I'm not going to make an endorsement in this race. ... My strong suggestion is to go with the leading candidate, Mike Johnson." Bloomberg's Kaylee Lyons joining us now. Kaylee, isn't that an endorsement?
Well, maybe not in so many words, Lisa, but remember, Donald Trump did help sink Tom Emmer's bid yesterday for the speakership. He only lasted as the speaker nominee for about 4 hours and 10 minutes after Trump said that it would be basically saying that it would be a mistake to elect him speaker. So we'll see if the fate of Mike Johnson is different after Donald Trump came out and at least suggested that those in the Republican conference should support him. Now, in the Republican conference meeting last night, when he secured the nomination, they then took a roll call vote in which Congressman Michael McCaul described almost unanimous support for Mike Johnson. Only 3 voted present rather than voting for him. There were a handful of absences, so we don't know exactly what the math will look like on the floor come noon today, but there is a feeling in Washington this morning that he might stand a better chance of actually getting 217 votes and getting the gavel than those who tried before him. Not just Tom Emmer, but of course also Jim Jordan and Steve Scalise. There is the fact that he does appeal more to the harder right flank of the Republican Party in the House, considering he did support Trump's efforts to overturn the 2020 election result. But he also just hasn't been around that long in which he could have built up enemies internally. He was first elected in 2016. Yes, he chaired the Republican Study Committee, but he doesn't have that much leadership experience. And while that could work in his favor in actually getting the gavel, it might work, or it could be a challenge for him going forward if he does indeed become speaker and then immediately has to be put in a room with Chuck Schumer and Mitch McConnell, Hakeem Jeffries, maybe even President Biden, as they all are going to have to work together to figure out a way to continue to fund the U.S. government past the deadline of November 17th. So if he gets the gavel today, and that very much is still an if, we'll find out this afternoon, he definitely has his work cut out for him going forward, Lisa.
Kaylee, when you walk the halls of Congress, what do you feel more of, frustration or urgency?
There's been a little bit of both, I would say, as time has gone on, considering we are now day 22 without a speaker and we've run through a series of candidates. There is growing frustration, but there also is a growing sense of urgency because the more days it takes to elect a speaker, the closer we get to the government running out of funding. And of course, there's also the Israel challenge laid on top of that with the supplemental request from the White House and a need to address that congressionally. And you need a functioning House to do that. So I think everybody's kind of reaching a breaking point here, Lisa.
Kaylee Lyons, thank you so much. Still with us is Patrick Frizzetti and Zachary Griffiths. Zach, from your perspective, how much is some of the dysfunction in D.C. part of what's behind the lift that we're seeing continue today in yields?
Lisa, I think it's certainly a factor. It's hard to quantify, but when you think about rising deficits or rising financing needs at the Treasury, and we're going to find out more about what exactly that looks like at next week's refunding, which was a big driver of the move that we had higher in August, it's certainly playing into it at the margin. And I think that the longer that this goes on, the more that you can expect Treasury yields to rise or remain under pressure in the near term, and for investors to have their mindset shifted from a longer run perspective into the safety of U.S. Treasuries. I think it's a terrible development that this continues to go on, and is certainly going to have an impact on borrowing costs in the U.S., and I think we're already seeing that.
Well, and Patrick, this sort of feeds into some of the angst around next week's refinancing announcement. We get a sense of just how much bigger some of these auctions are going to be that come out periodically from the U.S. Treasury Department. How worried are you? How closely are you watching the reaction in markets to understand if yields are going to break higher or lower?
Well, we're watching it very closely. Quite simply, I would say the market doesn't like uncertainty, and they don't like, dysfunction. And to say, Washington is dysfunctional is an understatement. So yes, we follow rates very closely, and I do think they are, a predictor of things to come. So we'll see how it goes next week.
Patrick, do you think that that changes your view when it comes to risk? If you see yields going higher as a result of dysfunction and deficits, which is new for the United States, usually people had actually talked about higher debt loads in the developed markets leading to lower yields. This is a new paradigm. How much does that make you less willing to go and to lean really heavily into risk longer term?
Yeah, well, it's still a concern. So I would say, I think, leading into this, if you haven't positioned appropriately, I mean, this has been a concern for many, many months now. And so, we've positioned accordingly where we have a little bit more, liquidity. We had kept duration very short for 18 months. We can begin to possibly extend that a little bit longer, but overall, it's still pretty short and taking advantage of higher interest rates. And then on the equity side, like I said, there's still value to be had, no question, in different sectors. I think we're avoiding some of the things that look a little pricier or speculative, as we go throughout this earnings season. But yes, it's certainly a concern. And as I can just reiterate, the market doesn't like uncertainty, but that can lead to some opportunity, no question.
Zach, CFOs don't like uncertainty either. Are the CFOs that you talk with, that you analyze, understanding that these 5% yields for over the 10 years really might be the new reality?
I think there's a lot of concern around that. And when we think about what's really shaped where yields head directionally and the shape of the curve in the past, a shift in monetary policy tenor, and so a turning point in the Fed cycle, if that were to come to pass early next year, has historically had a larger impact on where yields go in the shape of the curve. If you look at the past 6 tightening cycles and the 3 months after the last hike, which we think was in July, yields have moved lower on the order of 75 basis points on average in the 2-year and 10-year. And so this move recently has really gone in contrast to what you'd expect if the monetary policy tightening cycle is in fact done, which is certainly up for debate. And I think part of that has to do with the supply story and all of this uncertainty. So when we look ahead to next week, we do think Treasury is able to downshift, at least with respect to the pace of auction increases, especially as you've seen built auctions come up so much. And so when we think about how that shapes where yields go for now, we think the path of least resistance is higher going forward.
Unfortunately, we've got to leave it there. Patrick Frizzetti, Zach Griffiths, both of you, thank you. Coming up, the morning calls. This is Bloomberg. For our morning calls, a look at some of the analyst recommendations this morning. First up, Wells Fargo upgrading the gap to overweight, highlighting recent turnaround efforts and cost control measures. Next up, Piper Sandler downgrading Regions Financial to neutral, moving to the sidelines after lackluster results. And finally, Citigroup downgrading Etsy to neutral, seeing limited visibility into next year. Coming up, the opening bell, we've got RBC's Amy Wu Silverman and Dan Salmon of New Street Research. Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Ferro, just moments away from the start of trading at a time where everyone is watching for some sort of earnings understanding of the picture. We get, of course, more after the bell. 0.4% decline on the S&P. NASDAQ down 0.75 decline. How much is this the Google effect? Outside of bonds, you can take a look at yields. They are climbing, so that is retreating in terms of price, and that really might be underpinning some of the anxiety. 10-year yields 4.89%, still 11 basis points away from that 5% threshold. Dollar strength, euro weakness after those negative PMIs yesterday, positive U.S. data, and crude prices basically waffling around, trying to find a bid in the uncertainties, the vagaries, and the geopolitical issues that have arisen. One stock to watch at the opening bell. Alphabet, its cloud unit reporting a smaller than expected profit. The CEO shifting the discussion towards artificial intelligence, saying, quote, "We're continuing to focus on making AI more helpful for everyone while making exciting progress with lots more to come." Didn't talk about the cloud, and that's where all of the equity investors have been focused on. Ed Ludlow has more. Ed.
Yeah, good morning, Lisa. This is a big move lower by Alphabet, the parent of Google, down 8%. That puts it on track for its biggest drop since October of 2022. The story is really clear. a miss on the top and bottom line for cloud, but a pretty significant beat across the board on all other metrics. And the cloud story is interesting. Sales of $8.41 billion, below street estimates of $8.6 billion. Operating income in the unit of $266 million, below operating income estimates of $434 million. When I spoke to Ruth Porat, who is now the President, Chief Investment Officer, and CFO of the company, she called this customer cost optimization, which is cloud speak for customers cutting back on their cloud spend. You highlighted what Sundar Pichai had to say about the AI story, and when I asked Ruth Porat if they were able to add new customers in the quarter because of generative AI, she describes what they call a backlog across all AI applications, but no data that would kind of support forward-looking growth specifically for the cloud. We saw resilience and stabilization in search for Google and also ads for YouTube, but it basically isn't enough. And at the center of this story is the idea that Google Cloud is a distant third behind Amazon AWS and Microsoft Azure, which you're just about to hear about being the opposite story. And even though there is resilience in its sort of legacy ad business, it's going to be the growth in cloud that comes as a result of AI investment, and there wasn't really enough to get that over the line. Some analysts have cut price targets, some analysts have actually raised price targets, but all of them agree that it's kind of evidence that we're not yet seeing the effect of spend to power generative AI just yet, at least in Google's context.
Ed, thank you so much for that more positive outcome for Microsoft, as you were mentioning, Ed. Talking about the strength of its cloud business and AI demand, the CEO saying, quote, "We're rapidly infusing AI across every layer of the tech stack to drive productivity gains for our customers." It sounds great, but everyone was also focused just on the fact that Azure came out with incredible results. Isabel Lee has more. Isabel.
Hey, Lisa, Microsoft was indeed a talk of the town, and for a good reason. The three business segments of the company, which is productivity, intelligent cloud, and personal computing, all had beats and all beat their estimates. Shares are on track. If gains hold right now, and they're popping by almost 4%, we will see the biggest gain in 3 months. So the optimism is really largely because of its cloud business by Azure. Company's strong sales are coming in at $56.3 billion. The company was also boosted by its investments into AI. It poured around $13 billion into the firm behind ChatGPT. And this makes one wonder, did investors really underestimate the cloud story amid all this AI frenzy? Amazon is still the leader in this area, though, and it reports on Thursday. But for now, for Microsoft, revenue in the first fiscal quarter rose 13%. So this is the most in 6 quarters, and it topped all analyst expectations. Profit was $2.99 a share. And as for Azure, we saw that the sales gained 29% versus 26% in the previous quarter. So analysts say if we see stabilization, then the euphoria will continue. And analysts also say that overall, yes, the cloud business did lift up everything, but it was a broad-based gain. So good day for Microsoft, indeed, and shares are now up by 4%, Lisa.
Isabel, thank you so much. It's good news and bad news for Boeing as it reiterated its yearly cash flow forecast, but lowered its annual target for 737 aircraft deliveries. CEO saying, quote, "When we set our recovery plans, we knew issues would come up along the way. This is a complex, long-cycle business, and enduring change takes time." Joining with more is Abigail Doolittle. Abby.
Well, Lisa, good news, bad news story indeed. It's a real stop-and-start recovery out of the pandemic, and one interesting point is the fact that this company has now put up its 9th consecutive loss in a row. This one wider than expected, missing the estimate by about 10%. The 737 production missing the mark as well. But to the upside, as you were talking about, they've maintained the free cash flow outlook for this year. They are keeping the goal of $3 billion to $5 billion in free cash flow. They've also kept their mid-decade targets, and offsetting that 737 weakness is the 787 wide body. The production targets there are looking pretty solid. Now, for the 737, they guided down to 38 jets per month. They're hoping that will increase by the end of the year. For the 787, that bigger plane, they're looking at 10 jets per month. One analyst of Vertical Research Partners is saying that they are hanging on by their fingernails, maintaining this free cash flow. The stock really reflecting that at this point, up 1.9% on the year, though, Lisa. This stock basically flat, reflecting the frustration that investors have about this good news, bad news story for Boeing.
Abby, thank you so much. Turning back to tech, Snap delivering revenue growth in the 3rd quarter after 2 periods of declines. The CEO saying, quote, "We're focused on improving our advertising platform to drive a higher return on investments. Simone Foxman has more. Simone.
Yeah, Lisa, this stock has been all over the place, not just since the company reported earnings. In the post-market, it was up about 24% before reversing all of those gains pretty much. Now we're looking at shares up 3%. They had been up about 8%. And really, analysts trying to figure out what to make of all the mixed messages here. The financials were pretty positive. They returned to revenue growth in the third quarter following 2 periods of declines, a net loss that came in lighter than anticipated. But the company also saying that it actually could be hurt by the impact of the war in Israel and Gaza. Brands slowing their advertising campaigns, putting them on pause since the start of the war. And the company says that could continue into the fourth quarter, making the outlook for that quarter very difficult to determine. In fact, saying that it would be imprudent to provide a formal outlook. The company's in a year into an overhaul of its business. Its Snapchat Plus revenue service or subscription service has been pretty positive, as has users' engagement with an AI chatbot. But analysts, despite the fact that they're pointing to some of these positive 3Q numbers, seeing a difficult outlook on long-term. Vital Knowledge saying results okay, but the company is a minnow in the online advertising space to the likes of Meta, Alphabet, TikTok. And it's hard to see how that changes in the future, Lisa.
Simone, thank you so much. Sticking with tech, New Street's Dan Salmon weighing in on Alphabet's results, writing, quote, disappointment in cloud revenue growth arrived at Google. We'd expected this will be the #1 controversy for the stock going forward. Dan joins us now, has a buy rating on the stock and a price target of $160. Right now, it's below $130, $127 a share, with the biggest share drop going back more than a year. What's your view? How can you be positive on a stock where people don't necessarily see the cloud growth that they need to keep the money flowing in now ahead of AI?
Yeah. Look, I think today's reaction obviously is mostly about where the third quarter number came in. It was below expectations. They decelerated a little bit more than what everybody was expecting. Where I think the conversation goes to, and your reporters hinted at it as well earlier, was, we saw Microsoft see a slight acceleration in their cloud business owing to AI. So they're clearly the ascendant one grabbing share here. I think what that's going to do is reinforce this narrative that Microsoft, in partnership with OpenAI and ChatGPT, have the momentum right now in AI. The reason that we're confident coming down saying that this is a buying opportunity is, if we look ahead, we know that Alphabet is going to be releasing their new large language model, Gemini, coming up soon, hopefully before year end. And that we think will be a big catalyst for the stock.
So, Dan, how are you getting confidence that you are going to see that kind of growth in AI that will translate into revenues in the near term, that can keep a price target that indicates a pretty significant rally after an already significant rally so far this year?
Well, I'm glad you mentioned that. I mean, look, the setup for Alphabet going into the quarter was a little bit difficult, as they've been an outperformer of late. So expectations were pretty high, and this is a little bit of a reset on that today. Look, we go back to what, Sundar Pichai reminds everyone on a regular basis, is that Google raised AI to be the #1 priority at their company 7 years ago. So, we don't think there's any company out there that has invested more in a full stack, including their own proprietary infrastructure, the cloud platform, and otherwise. But no, they are chasing Microsoft a little bit here right now. We're confident that they can get that back online. The other thing that mentioned earlier as well is the ad business is going well. The search business outperformed. That is still the engine of profitability for the company. We think they're benefiting from a strong e-commerce market, especially some incremental advertisers like Temu and Shein from the Chinese market. So that's still the engine of profitability. But we think, like I said, if we look ahead to the launch of Gemini, there's a big potential catalyst coming for Alphabet that we think can reinvigorate investor sentiment.
I'm glad that you mentioned advertising, and that's something that's a very big question, especially after our own Simone Foxman just went over how Snap has potentially some hangups in that area in terms of how much they can grab on that. We get after the bell today, Meta or Facebook. How much do you think that the positive advertising trends that you saw in Google, Alphabet, will be continued through Facebook or Meta at a time of really shifting demands and clear consumer preference for no advertising?
So the first part, of course, where current ad trends are going to be based on is where demand is from advertisers right now, and similar to Google highlighting strength in e-commerce for supporting their search business. That's the biggest category for Facebook's advertising, Facebook and Instagram or Meta. So I think the near-term trends for that are going to be very solid for Meta. And we've seen them continue to rebound throughout this year after taking it on the chin like Snap from some of Apple's privacy changes last year. To your point on consumers' preferences shifting away from ad support, generally most consumer media platforms have always offered some options of ad support versus not. HBO was out there for years as the network without advertising. You mentioned Snapchat Plus, which is Snap's subscription service. They're also slowly but surely rolling out an ad-free version of it. That's the opportunity for social media companies, is to diversify their revenues and establish ad-free subscription services. That's something we've seen reports on coming from Meta potentially and partially as a reaction to some of the restrictions that we're seeing in Europe on what they can do with their ad business.
So just real quick, Dan, do you think that we're going to get a positive surprise tonight for Meta?
I think the results will be good. I think they're expected to be good. So ultimately, it'll be, are they good enough, relative to expectations? We have a buy rating on it, especially getting a little bit of pullback in sympathy with Google here tonight. Right now, which again is really about the cloud business. That's not relevant for Meta. It's all about the ad business, and I'd expect them to be strong.
Dan Salmon, thank you so much for being with us. Coming up, geopolitics keeping markets on edge. That conversation up next with Amy Wu Silverman of RBC Capital.
What needs to be done right now is to deal with the context as it is in this particular moment, obviously with sensitivity towards the grievances, but with a recognition that Israel has a right to defend itself, that there is a severe humanitarian crisis in Gaza, and that there is an effort to get humanitarianism in.
Diplomatic efforts to avert a wider Middle East conflict intensifying as Qatar hints at breakthroughs in hostage release negotiations with Hamas. The U.S. pressing Gulf allies to help clamp down on a suspected increase in fundraising for Hamas, calling a special meeting to prevent more deadly attacks. A Treasury official saying, quote, "This moment should bring a profound sense of urgency, clarity, and purpose to the work that we do. The ability to act to cut off the financial flows that feed terrorism is a duty we all share." Joining us now is the one and only Anne-Marie Hardern in Washington, D.C. Anne-Marie, starting there, we also heard about a conversation through the Saudi prince, Mohammed bin Salman, and President Biden, which is highly unusual. What's the latest in the U.S.'s attempt to stave off a regional conflict?
Yeah, it's very unusual. Remember, this was an individual that President Biden, when he was campaigning, said he wanted to make a pariah. Now the U.S. really sees Saudi Arabia as an ally in the region, and especially when it comes to this conflict, because the United States is continuing their frenetic diplomacy, as are other world leaders, because what world leaders want to make sure is that this conflict stays isolated within Israel and Gaza. They do not want to see this widening and spreading. So not only did we have that phone call yesterday between President Biden and Mohammed bin Salman, but also we have Emmanuel Macron, who's leaving Israel, visiting Egypt today. We have the Austrian chancellor going to Israel. We have the Czech prime minister going to Israel. So you can see this flurry of diplomacy is not stopping. This is top of mind of world leaders. They want to make sure that they can contain this crisis. And of course, we heard from the Qatari foreign minister, they seem to be making headway when it comes to hostages. That seems to be a main focus as well for global leaders.
How much is Israel listening to Biden when it comes to all of this? Is Biden directly talking with the Israeli government to try to maneuver in all of this?
Well, of course, we have President Biden holding a number of phone calls since the October 7th massacre with his counterpart, Benjamin Netanyahu. He obviously made that trip there. And then U.S. officials are talking to their counterparts. Publicly, U.S. officials will say they are offering intelligence. Obviously, the U.S. is standing shoulder to shoulder with Israel. They've made that clear. But what we have reported is that European and U.S. officials have been pressuring Israel to slow down any ground invasion until they could potentially make headway when it comes to hostages. When President Biden was asked about a ceasefire, he said, we need to get those hostages out first, then come talk to me.
Anne-Marie, thank you so much. Oil prices remaining grounded as the Israel-Hamas war remains contained, at least for now. Brent oil flirting with a fourth day of declines after giving up roughly half of its Middle East risk premium. Bloomberg's Abigail Doolittle has more. Abby?
Yeah, there's been a tremendous amount of volatility for oil recently, but it's not just over the last few weeks around this Israel-Hamas war, Lisa. It is all year. Oil has been whipsawing up and down on various demand and supply outputs. Now, over the most of the summer, oil had actually climbed by as much as 40% from its year-to-date low to the peak. And the story there was that the OPEC plus production supply cuts, that they were keeping oil in check. And then we, of course, had that sudden decline back below 90 toward 80. And then on the conflict, we, of course, had not just oil, but the entire energy complex really rally on the idea that there could be supply shortages. One of the biggest mover on the conflict, Lisa, of course, was European natural gas, at one point up 30 to 40% in just a few days. And then, of course, as Chevron shut down one of their natural gas offshore drilling rigs. Oil right now, though, Lisa, back below $85, technically breaking down. It looks as though we could see a big directional move either way, slightly more skewed toward the downside, maybe toward 70 soon, Lisa.
Abby, thank you so much. Joining us now is RBC's Amy Wu Silverman. And Amy, we talked earlier when this conflict first erupted about how exactly nervous traders were, how much they were hedging against potential tails. Have those tails been taken off? Are people less nervous in the trades that you observe?
So, you know, what's funny, Lisa, is I don't know that I would tell you that the tails were ever placed. This has been very interesting to watch. It's obviously been such a severe human toll. But 2 weeks ago, when this happened, you actually saw relatively muted action coming out of the options market. That increased a little, but really not by that much when you look at other historical conflicts, Russia-Ukraine, for instance, where you actually got a VIX headline peak of nearly 40. We just never got close there. We've always stayed under 20 on that headline VIX, and those tails still remain kind of near historical kind of 5-year lows despite the ongoing volatility.
Are you surprised by the complacency, given how some people have been saying some of these tails are fairly cheap?
Yeah, and I guess I would add that I'm one of the people saying that these tails are fairly cheap. Look, I think the market to some degree, there are some technical reasons why overall we've seen muted index volatility. There's been a dramatic amount of volatility selling programs in our space. There's been dispersion in our market. A good example is just what happened overnight with Microsoft and Google. Look, when those two big index weights move in different directions, what does that do to the NASDAQ? It kind of keeps it balanced. We've been suffering from that paddling duck situation in the market for a while, and that dispersion is implementing changes in correlation to our market, which keeps it muted. But again, I do think we are a little bit complacent. We also have no Speaker of the House. I think there are a lot of event risk items out there that could drive a bit on the index level.
Do you think that that actually is a potential event risk? Because a lot of people have gotten used to shrugging that off too. Washington dysfunction, what else is new?
Yeah, no, that's a totally fair point. And, you know, I always point back to 2011, where when we had that initial debt ceiling crisis, we went to a VIX of almost 45 and we stayed around 30 for the remainder of that year. I think we've been trained since April of this year to say, look, this is kind of a non-event. It's been can-kicked. That said, it is a little bit unprecedented to not have a speaker, and we still have other ongoing strike issues. So, look, I don't think you can just say, you know, been there, done that, seen this movie. I do think it's slightly different.
If we do get some sort of stability in the bond market, do you think that the ammunition under the hood is there to really stage a rally?
I definitely think that's possible. So, you know, look, at the end of the day, what is driving equities, that rate narrative has been such a huge component of it. I will tell you, the way that positioning is right now is extremely different than it was 4 months ago. So if you look to the single stock side or the index side, just that positive headwind where that momentum begot momentum on the big mega cap tech names, that is all but gone. And so if people need to do that chase very quickly, I think we could get into a position where folks were offsides and then they have to do that tailwind catch up, which is something that we saw in NVIDIA during the first earnings cycle.
Amy Wu-Silverman, thank you so much for being with us. Coming up, the market moving events that you need to be watching. That's next in our Trading Diary. Time now for the Trading Diary. You need to be watching this week. The House planning to hold another speakership vote this afternoon. Meta earnings coming after the closing bell. Amazon reporting on Thursday. Plus, we'll get an ECB rate decision and U.S. GDP. And on Friday, earnings from ExxonMobil and Chevron at a time when there is a great consolidation, a great roll-up in the shale space. From New York, this was Countdown to the Open. This is Bloomberg.